Today on the Tearsheet podcast.
Midway through life, I was realizing very quickly, instead of improving the financial outcomes of myself and the banks that I was working for, wouldn't it be great if somehow we could build with technology a system, a bank account, financial services industry, as a financial services company that could align with our members, our customers, and improve their financial outcomes. And I just thought, couldn't we just apply all this mental capital and all these ideas that we have, and just materially help people in their day-to-day lives? And so that's our mission.
Welcome to the Tearsheet podcast. I'm Zack Miller. When you talk to the founders of many of the leading challenger banks, you sense that each has a touch of revolutionary in them. They see the present financial services system as broken, some more, some less, and their firms are out to provide better options for the bulk of people out there. Stuart Sopp's the CEO of Current. Growing up through the industry as a trader, Sopp made a decision halfway through his career to leave his job and build a challenger bank that's targeting Millennials and Gen Z with lower or no fees and early direct deposit. Current saw 200,000 new users in April and May during the height of the corona crisis. The company has more than 1 million active accounts. Sopp joins us to talk about the genesis of Current and how it's helping its target customers. In a crowded field, he describes how Current differentiates itself from the other offerings out there. Sopp tells us how he thinks he can double his user base in 2020. Stuart Sopp is my guest today on the Tearsheet podcast.
Hi there, my name is Stuart Sopp. I'm CEO, founder of Current, and we are a mobile-first challenger bank based here in New York for the U.S., serving the U.S.
Funny, you don't have a New York accent.
Yes, I don't. I married an American woman, and about 8 years ago, I moved here from Hong Kong. I used to work for Morgan Stanley, Citi and Deutsche over my career. I was a trader for many years, foreign exchange, short-term interest rates. So I got to move to different countries. And then sort of the final stop, it seems, has been New York. So I moved here in 2011, just after the previous crisis to the one we're experiencing now.
That's a signpost. The crisis is, yeah.
Yeah, I started my career in '99, so I've seen a bunch. And so, yeah, I'm English, but I've lived here for a significant amount of time.
So I think your background is important. I want to hear that. I want to hear how a trader in Asia, becomes a founder of a challenger bank. So can we talk about that and the genesis of Current?
Yeah, absolutely. Yeah, it's a non-standard way in, and I get this question a lot, especially from the West Coast VCs, because pattern matching is very important.
You have to look just guys. Like everybody else, Stuart. Yeah, exactly.
Yeah, with the beard, long hair, English accent, and from Wall Street, based in New York, right? So yeah, definitely not part of the pattern recognition. In trading. Was responsible for a large part of Morgan Stanley's trading business in foreign exchange. Saw the advent of Bitcoin here in New York in 2010-ish. It was just after it come out, really, in around the world in the engineering fashion. And really being a transplant from another country, being in Asia who hasn't got any legacy banking infrastructure, it was really that sort of introduction to that group in those early days. It was sort of anarchistic, anti-bank, anti-government kind of people. And I was sort of hanging around trying to understand really what was happening in that technology. And from that, I learned that America has a pretty interesting problem. A pure capitalist society and structure, unlike Europe, 50 states federal system created this really interesting problem whereby access to banking certainly wasn't super low. It wasn't easy. Banks focus on deposits. Obviously, that's their main KPI, to go and lend that money out. And of course, a large part of America now lives paycheck to paycheck, and that money whistles out of everyone's bank account on the day they get paid. So, from that lens, I was like, why are people focusing on like a free bank account and free access to money and outside the banking system? There's this massive animosity developed from 2008. I thought it was super interesting. So from that sort of worldview macro trader into this new technology that was sort of very nascent here in New York, I started to build this idea, and obviously seeing the European challenge banks sort of spring up for very different reasons, by the way. I was sort of very intrigued and sort of looked around and went, well, if no one else is building this solution, I may as well give it a go. And that's really 2014, 2015 is where I took the leap and sort of resigned and left my old trading world behind.
And what's the notion, right? So you talk about sort of the brokenness in the system. Like, what's the idea in terms of being able to do it in a better way?
Yeah, so there was a couple of things that I sort of identified. One was obviously distribution was changing. So we'd gone from branch network. I know that the industry is heavily into the branch network, but maybe that will change post crisis here now. But we've gone from a branch network distribution to internet, right? So we had internet banking, and now only a very few people had gone fully mobile first, right? So there was this mobile revolution that was happening in sort of the 2010s. Literally, and we've seen peak iPhone, right? Like everyone has a phone now, and so that was interesting. So new distribution channels means that there's new opportunity because there's different formatting and how you interact with digital money. And then on top of that, banks, like I said, there's 4,700 banks here, 50 states, and all this other stuff, 5,000 credit unions. And so a heavily populated banking infrastructure, banking fraternity, and they have this legacy infrastructure. Many of it, unless you're the top 10 banks, you really can't afford your own, right? So you're with FIS, Jack Henry, and all these other guys, and you've sort of like since the 90s got card processing outsourced and all this other stuff. And so as we're seeing a sort of collapse in efficiency mechanism in servicing customers, the technology cost has been fairly fixed, and the OpEx cost of these banks has been very fixed and very high. And so that's a hurdle rate in terms of monetizing or even just breaking even on an ever-growing and large demographic here in America. So like I said, if you're earning $50,000 HHI, you're basically paycheck to paycheck. And now that is now 100 to 130 million people, so a third of America, right? And so what we've seen here is that massive banking fraternity effectively monetized with overdraft fees, late fees, all this other stuff, right? And so they get an effective interest rate. Now, the collapsing macro environment, the issuing of so much debt, discount rates going down and all the rest of it has just meant, and obviously banks are not that great at lending anyway, as we've seen from this PPP stuff. And, it's just, it's very hard to do that in that kind of scale and volume. And so what we're seeing here is like a structural dysfunction of how banks are set up. We just don't have the demographic or the interest rate for a lot of these incumbent banks to survive. So I identified this early on, obviously in mid-2010s. I was like, okay, wealth inequality is real. If you have assets that are inflating, you're doing plenty fine. And we've seen a V-shape V-shape recovery here with this post-pandemic. And that's really, M2 and all this other stuff are part of that story. Just, a lot of money chasing fixed assets. And then if you have debt, you need to service that debt and you get into more debt. And as that happens, interest rates are falling and probably not really going up over at least the medium term. So now you have this wealth inequality system in America whereby, the half that has all the debt really can't afford to do much else. They can't accumulate any money to invest in assets, and so you just have this striation. And of course, banks are traditional banks are focusing on people that do have money because they need those deposits and they invest and all this other stuff. And so their systems, their unit economics are not set up for an increasing population of America, a large population of America. And it's a technology problem. It's a demographic issue, as we've seen socially in America, and a distribution problem, right? So those three things, we were identifying then, and so we built our own banking core called Current Core. If you think of a regional or a community bank, they spend something like $10 or $12 a month on an open account for technology costs alone, which is a lot. Mm-hmm. Our system maintains an open account for something like 10 to 15 cents. So we're able to have gig economy workers, essential workers, people who don't collateralize the account very often, like teenagers. We have a teenage bank account as well. And we're able to profitably open those accounts and acquire them in a very efficient manner.
Awesome. And so what is this demographic actually looking for from a bank or from Current?
Yeah, good question. So primarily liquidity management. So if you're paycheck to paycheck, you don't have enough money, like I said, to really save. So APRs don't mean anything anymore anyway for the majority of us, but they certainly don't mean anything if you're living paycheck to paycheck, right? So if we can get their payroll in their account 2 to 3 days early, if you're working at Amazon and you're through this pandemic, you're an essential worker, you took overtime, you got paid more, right? So they had more money. They may have saved a little bit, but not too much. It just meant that you could pay off your bills more. And so you're getting paid on a Friday. Typically, we will pay someone like that on a Wednesday night or Thursday morning. So you're getting paid before your coworkers. So that's kind of cool. And so many of your listeners will be thinking, well, that only happens, the first time you sign up. What about every week? The reason why that's important is because now I've got my money sooner. I can take overtime and new shifts and all that stuff, and I can pay off any other late fees. And so really it's not just the banking industry that has this penalty fee system. It's cell phones, it's utilities, it's car payments, it's all this stuff. And so what ends up happening is that if you have a medical bill or something happens, like your store closes down, you're an influencer or gig economy worker, and pandemics happen, you don't have that income. All of a sudden, all those fees mount very, very quickly, snowball into like hundreds and hundreds, if not thousands of dollars. And then you're in a default kind of scenario. And so just getting that money into their bank account quicker means that they can clear those quick in time and not get penalty.
So that takes a lot of guts to go into this market and to align yourself, I think, with people who are really struggling financially. So like, is that the main differentiator you would say between Current and maybe some of the other challenger bank offerings out there?
Yeah, thank you. I hesitate to say I'm part of the problem being a trader, but like I really wasn't helping anyone other than the banks I was working for. It was very much an efficiency mechanism, which is needed. Don't get me wrong. Like markets need to be efficient and liquid, but really, midway through life, I was realizing very quickly, instead of improving the financial outcomes of myself and the banks that I was working for, wouldn't it be great if somehow we could build with technology a system, a bank account, financial services industry, as a financial services company that could align with our members, our customers, and improve their financial outcomes. And I just thought, couldn't we just apply all this mental capital and all these ideas that we have, and just materially help people in their day-to-day lives? And so that's our mission, by the way. That's been really great to be able to do that. There's other things that people care about, not just liquidity management, although that's the main part. We have an overdraft facility, again, helping people paycheck to paycheck. And like we said, that team bank account, and there's a bunch of other stuff sort of coming down the pipe.
And how do you guys make money?
Yeah, so we're an interchange model as well, like many of our competitors. Mm-hmm. Suburban, clearly the game in this at this point. We have issuing banks that we work with and partner with, which is great. We do use some parts of card processing, although that is becoming less important for us. Clearly, card processing was the fintech of the 90s.
Yeah.
So, and we're going to see that all change over this next wave of, the winners out there are all going to be doing various things themselves. We also have a subscription fee. We're kind of unusual in this game to have that. A lot of people are just purely free and sort of rely on that interchange model. We have a subscription fee, and that's mainly because of our roots from team banking. Mm-hmm. If you're going to build your own banking core, it's extremely hard, as you can imagine. And we started with a cohort, a demographic of people, teenagers who, and the reason why was because they don't need much, right? If you started with a 40-year-old, you'd have to build joint accounts and auto loans and credit cards, and it would just be too much. And so we started off with young adults. And so when you're trying to work out business models for them, it's actually really hard to make money. And also you don't want to encourage, consumerism, someone under 18, right? So you align yourself with a parent and charge a fixed fee, monthly fee that you build annually. And so we carry that on into our business model with the full checking accounts, which has been interesting. And so it's really been a focus of the product teams to provide enough value so that upfront fee really sort of dovetails with consumer expectation.
Yeah, we definitely seen the European challengers, move into sort of a freemium model where they do have a premium subscription fee on some of their accounts. What do you charge for that? Like, what's the structure there?
Yeah, we charge $4.99 a month for our premium account. We have a totally free account called, which is our basic offering, which many of the credit features are rolled under the premium account. So that, for the consumer, for our members, they're like, okay, this makes sense. I'm getting my money early. I'm getting an overdraft facility. I'm getting my gas holds credited back to me within within a couple of minutes. I've got savings pods, brand blocking, all this other stuff. And so the value is there for that $4.99. But yeah, the Europeans, it's a very different structure over there. So,
Yes.
Socialist structure. And clearly, like the unemployment benefits are way better and bigger over there. So people, and also, single regulatory bodies instead of like 50 of them or 51 of them. And so they're able to offer financial services at a much lower cost, and really there isn't a banking problem for sort of lower income in Europe. And so what they're focused on is foreign exchange moving around all those countries, and also sort of like more affluent users, a secondary account, if you will. Whereas here in America, we're actually going for primary financial relationships.
So, Stuart, it sounds like you have a pretty broad product set already in current. What are you guys thinking about in terms of developing in the future?
Yeah, so liquidity management, if you were to sort of draw straight lines, we're in credit a little bit, if that makes sense, but it's kind of almost collateralized with payroll and various other things that we do. So it's very, very safe. Our DNA is in the banking sort of payment side, and drawing straight lines would be credit lending and things like that. And it's a very cyclical business, very capital intensive. Maybe a good time now. So I think you'll see us and a few of us dip our toes into that. I think the standalone lending businesses are proven, without the deposit side, not to be that useful, not that valuable, I would say.
Yeah.
And so, looking more like a traditional bank, but not in the sort of breadth that a traditional bank would go out with, right? So with, if you look at the paper, banks typically sort of one size fits all brand, one size fits all products, have 2,000 products that you can sort of wash people through, and they'll pick and choose, and they do this, cross product selling business. What we have done is said, hey, let's focus on a demographic, sort of turned the page 90 degrees and said, look, we're only focusing on these people because they're the only people we see with a banking problem in America. And we will service them with products that only they need, right? We're not going to build stuff that they don't need. And if we do go after a different demographic at some point, well, then we will look at those products and services that make sense for them. So in terms of product development, you'll see that. And also, we're not quite there with feature parity with a traditional bank, right? So we don't have wire transfers and things like this. So we're focusing on some of those little things that'll be developed over the next coming quarters. And then finally, just giving value back, as much value back to users as possible. When you think about paycheck to paycheck, lower income, you're never going to have enough money. You're never going to accumulate enough money to save. And so the biggest savings you ever get will be discounts. It's 10% off, 20% off where you're shopping. And so a large part of our future will be focused on that vector.
Okay. That makes a lot of sense. As you were saying that, another question came up. Who do you see yourself competing with? Do you see yourself sort of replacing a traditional bank that hasn't serviced this demographic fairly, maybe, or do you see yourself competing against other sort of digital options?
Yeah, so we are deposit agnostic, meaning we don't want that as our KPI. As soon as you get a bank license, or you start to focus on deposits, we're just like the 4,700 banks and 5,000 credit unions in America. So and that's a pretty tough pack to roll in, right? So we don't feel like we've got any edge against people who have been doing this for a lot longer with bigger balance sheets. So really, not really focusing on that. Sorry, I've just. What was your question again?
Really, how you're positioning yourself competitively? Are you a substitute to traditional banks, or do you see yourself competing more with other digital options?
So we don't see ourselves competing with traditional banks because of that reason. Obviously, fintech is a broad category, and like I mentioned, the Europeans are targeting more affluent millennial customers. And so we fit neatly in our kind of almost our own sector. So we're sort of, we're acquiring customers who are on average age at like 26, 27, working in urban areas across America in every sort of densely populated area. And so not everyone is going after these users, mainly because we have our own technology stack, our new distribution, all this other stuff, how we acquire customers. So it's sort of technology enabled demographic differentiation, which is a big mouthful, I admit. And so really our competition, we don't really see any yet. And the existing incumbent solutions typically are cash, prepaid, other forms of debit, but very expensive, or just your bank that, you know, every bank and credit union has an underserved and a teen product offering, but very often their unit economics are just terrible, and so they won't promote them. It's more of a charity or a social service kind of thing that they're told to do or need to do, and so really not focusing on people that really need the help. And so we're able to do that, right? So we're just able, and that unlocks us to really focus on this problem. So we do have you know, a lot of people competing with us, but really no one is focusing on this demographic.
And I guess we have time for one last question. You know, we're already halfway through 2020. It's incredible to think that we are. But what are you most focused on? You know, you talked about some of the product enhancements, features you're rolling out, but what are you most focused on as CEO through the rest of 2020?
Yeah, what a crazy year, right? Yeah. So 6 months in, definitely did not predict all these events. So you know, we through the pandemic were able to you know, really adjust and react to a very dynamic situation whereby the government was paying people through the IRS, direct depositing information that they had then into unemployment, and really, you know, focusing on our users through social injustice that has happened. You know, over 50% of our members are African American. So you can imagine through this, you know, 6 months, we have been extremely busy and making sure that we're authentic and solving real problems alongside our members. And so that, you know, very proud of our team, very proud of, you know, everyone who has been a part of the solution here. Going forward, well, hell, I mean, I don't know. I don't know what more 2020 has to offer, and I'm a little reticent to predict it. But the, you know, I think in terms, you know, we're a privately funded company. The funding scenario situation is clearly doing very well now. There's going to be more money than ever, and so differentiation compared to you know, some of our competitors, fintech competitors, as well as, you know, the incumbents, is going to be interesting on our product roadmap to really sort of stick out. And I feel like, you know, the race to digitization / mobile distribution for the incumbents is clearly there. They've just seen like massive haircuts on their growth and massive haircuts on NIM, right? Like, so Fed has just crushed everyone again. So you know, you're going to see this renewed focus in what we're doing. In a variety of different ways, right? It's a demographic that everyone needs to care about and stand up for. It's technology that enables broad-based adoption and lowering barriers to financial inclusion and wealth, and closing the gap on wealth inequality. And it's a technology that basically no one has. And so for us, it's really highlighting, you know, the rest of 2020 is just, you know, showcasing our growth, doubling down on what we're good at, and releasing those products to give as much value as we can back to our members. So it's more of the same, and just, you know, reacting to some of these these curveballs that 2020 keeps sending us.
Definitely bring on 2021. Stuart, thank you very much for joining us on the Tearsheet podcast today.
Thank you, Zach. Great to talk to you. Thank you.